The Federal Reserve raised interest rates a few weeks back and is likely just to be setting the stage for a number of increases in hopes of putting the brakes on inflation. Alex Astin with Burns Financial joins us with a closer look at how this is designed anyway to help the economy and what sort of the risks are. Alex, good morning to you. So why now? Why raise interest rates now?
Well, the reason being is because we all know the world economy was shut down in 2020 due to the COVID pandemic. And in order to stimulate that economy back, the Fed, a tool that they could use was interest rates, and they lowered rates to zero. And that's because unemployment went over 14% during that time. So their approach was a dovish approach, and it was to reduce unemployment and do that through lowering rates. Well, now that we're about 2 years removed from the start of the pandemic, we've seen unemployment fall below 4%, and they see that as maximum employment now. And so really the main focus is to control skyrocketing inflation. We've seen that latest report over 7.9%, and it's probably not going to get any better over the next coming months. So the main goal here is to reduce that by raising rates and hopes to see inflation get back to normal 2 to 3% range.
So the idea is you don't shock the economy with where you're going to take interest rates eventually, but how many more of these are we likely to see?
Well, the schedule going forward, every Fed meeting for the rest of the year, I believe there's 7 left. The plan is to increase interest rates by 0.25% or 25 basis points during those meetings. But the Fed has since come out and said that they're not opposed to even increasing them by 50 basis points in the next coming meetings if they don't see inflation go the direction they intend it to, because a lot of people believe that the Fed has actually maybe been a little slow on the increasing of rates and the pumping up of the economy and their balance sheet. So they can't put their foot on the brake too quick, but they've certainly said they're willing to.
People have been concerned, though, about if this plays out in a negative way, the 1980 picture of high inflation, high unemployment, high interest rates. There's a risk here, isn't it, that they really have to manage this?
Yeah, I mean, the risk we've seen come into play already. If you think of the last month or so, the average interest rate for a house is at 5%, and that's much higher than it was, the 3% a few months ago. And we're starting to see a slowdown in that area there as well. The bottom half of the world economy is really where we're starting to see the slowdown. Of course, the upper half, middle to upper class, is still seeing an increase in spending and all that, but really we need to focus on the middle half and the lower class. And so really you've seen gas, groceries, education. So the risk that we run here of doing this too quickly is that we completely diminish demand, and then we have, like you said, high rates, low demand, and skyrocketing inflation. And so that's just a perfect storm. And so the Fed certainly has a challenge ahead of them to create this soft landing, and fingers crossed that they can do it.
And then we're just about out of time, but then the issues of Russia and some of the other, and whether coronavirus were to do something again, lots of wild cards out there. But Alex Astin, we appreciate your time this morning. Thanks.
Thanks for having me.